Hey everybody. So today I wanted to talk about the overall economy and where I think it's going, but I want to show you data and understand my thinking behind it. So we've done a lot of videos lately of the economy, different aspects of it, auto loans and home loans and all that kind of stuff. But I wanted to kind of give everybody a big picture because one of the things I like to do with this channel is I like to help people understand what I think it takes to actually solve problems and think through things and look at data and draw a conclusion. And I'm always open to looking at new data. I'm always open to maybe shift my opinion based on new information, but I keep digging into economics and I can't find anything that proves me that I'm looking in the wrong direction. And I understand I have a PhD in physics. Data is my life. Economic data is just another data set. And I'm trying to look every bit of data I can get my hands on so I can really understand the overall economy. So one of the things I came across this morning was this overall credit card balances for the entirety of the USA. And if you look at it over time, from the best data I could find was from the New York Fed, and they got from 2003 up through current, and we're coming down a little bit off the high of just like, $1.15 trillion or something. We're down to like 1.4, but it's a lot. So if you look down here, it'll actually show you, how many credit card accounts, what's the total balance of auto loans, credit cards, mortgages, student loans, and household debt, and is it going up or down from the previous reporting period to now? Well, overall consumer debt is up. Auto loan balances are up. Debt balances on credit cards are slightly down from 1.13 to 1.12 trillion dollars. Mortgages up. That means people are either buying a bigger home or taking out a second mortgage, some kind of home equity line of credit, something like that. Student loans haven't budged. The total household debt is up by $0.2 trillion dollars in the United States. That's a big number. $200 billion dollars basically in one reporting period. That's a big number. So that leads me to think, hey, what really is going on behind the scenes? So I looked at credit card delinquencies that are 30 days or more, and this comes from the Federal Reserve Bank of St. Louis. The data is a little confusing because I wanted to kind of look at, sort of a lot of parts of it, but it gives you four lines here. One is for the entirety of the United States. One is for the eighth district, and I was like, what the heck is the eighth district? Well, it's the eighth district of the Federal Reserve, which is the darkened parts of the map you see on the left-hand part of the screen. It's just sort of, middle of the country, not New York, not LA, sort of, breadbasket kind of stuff. And it kind of gives you a middle of the road one, but then it gives you the poorest 10% zip codes and the richest 10% zip codes. And yeah, even the richest 10% zip codes are, certainly their delinquency rate is less, but look, their delinquency rate is on the rise from 2020 through today. And if you live in those poorest zip codes, your delinquency rate on credit cards is up above 15%. That's a big number. But sort of everybody else is right at, sort of in between 10 and 15%. So that means one in 10, you get 10 people live in a street, you look at an apartment building, you got 10 apartments in it, one person is 30 days or more behind on their credit cards. And that's disconcerting. That's a big number. I mean, that's a lot of people that are behind. 30 days, okay, not that big a deal, but remember it's 30 days or more. So let's look a little more closely. So how much household debt do people really have right now? So here, this is again Federal Reserve data. So you've got mortgage debt is up, home equity lines of credit are up, student loan debt is up. Remember, this is in billions; it's not just $2. Auto debt up, credit card debt up. These are, medical or other kinds of bills. Maybe you took out a loan on a car, maybe not a car. Maybe you took out a personal loan, whatever it is, but that's other. So way up in all kinds of debt. Now, flow into serious delinquency. So that means is 90 days or more delinquent as a percentage. So that's not just 30 days. This is 3 months behind. So between Q4 of 2023 and Q4 of 2022, they don't have more recent numbers than Q4 2023, but mortgage debt is 90 days behind is on the rise. Home equity line of credit, people who had a HELOC loan, that actually the delinquency rates for those went down a little bit. That's a good sign. But this overall mortgage debt being that much different, that's bad. So that means people who took out a HELOC, a second mortgage, I'm sorry, they did a little bit better. But people who just had a regular home loan, man, that's way behind. Student loan debt, the delinquency rate went down. So I dug into that one, and there's been a lot of programs for helping people get back on track or deferring some payments, all that. So I don't know that that one really is because people got caught up, or if it's because they took advantage of those programs, because there's a lot more of those programs out, and they've been a lot more active with them. So take that one with a grain of salt. Auto loan debt, the delinquency rate is up. People have to get to work. That's bad. Credit card debt delinquency rate went up by almost 50% from 4% to 6%. And remember, this is Q4 2023, and we just saw on the other chart it's gotten worse since then. So that's bad. Other people went up. So across the board, people went from 1%, 1.03 to 1.42. That's a large increase in delinquencies. And that doesn't speak well for the overall economy that people are behind on their bills. So that led me to go look at, hey, what's going on with consumer interest, right? So we're getting behind on stuff. Why is that? Well, interest rates are up. So let's go look at how much interest people are paying. So this is from the Bureau of Economic Analysis, the interest paid on U.S. consumer debt as a overall percentage. So how much are we paying on interest? Is it going up? Is it going down? Is it going sideways? What's the answer? Well, we're paying versus 2020, we're paying sort of 65% more than we were paying in 2020. If you look at it from, I think that's 2021 versus 2023, because we don't have anything for 2024 yet, that's a 50% increase. That's a big, big number. Even mortgage interest is up because when somebody buys a new home, it's not buying it at 3% anymore. The interest rates on homes are up at 6, 7, right? So they're a little bit higher. Now, interestingly, on this one, part of what sent me down this pathway is I was talking to a real estate agent yesterday who works in one of the much more exclusive, high-priced areas here in Dallas that has homes that are nothing below 2 million bucks. They're all 2 million on up to, 10, 12, 15 million dollars. And she said she's actually seeing a large increase in people using mortgages to pay for those, including some homes that are in the 8-digit range. So people buying a home in the, above 10 million bucks using a mortgage, that's weird, especially that interest rates are higher, unless it's just because, hey, they don't really have the money to do it right now. Oh, I'll have the money in the future. It's okay. I'll pay it off. But if you're, say, buying a home that's, 2 million bucks or more, and you're taking a mortgage out at like 6%, that's a big number. So that's weird. But anyway, so let's go look at some more housing stuff. Home builder inventory for sale complete. Actually, let me go back a second. I want to reiterate something. Now, a lot of times when you buy a home and you buy it at a reasonable interest rate. So let's say I'm a super rich person and I've got 20 million bucks in cash. I can go do anything I want with it. And I say, hey, look, I'm going to buy myself a house. I'm going to buy this $4 million, $5 million house. And I say, okay, look, here's my 5 million bucks. Or if interest rates are like 2 or 3%, what you can do is buy the home at 3% and then use your money to go make more than 3%. So if you can invest it at 4%, it makes sense for you to take out that mortgage. But at today's interest rates was 7, 8, 9%, you got to invest really well to make that come out different, right? So that one to me seems a little bit odd, but it's me talking to one person, so I'm not sure if that really counts for a big thing or not. But this number, which is the entirety of the United States, that number is just way up. So that's not a good sign, especially considering way back in '97, you've got this really nice, consistent sort of number, and then all of a sudden we're just spiking through the roof. It's going crazy. So I went and looked at new home builder inventory. And this is interesting because the home builder inventory of homes that are built, ready for sale, um, you know, could buy it tomorrow, it's vacant, brand new house, 102, a whole bunch of those sitting on the market. Um, so 274,000 more are under construction. These aren't selling. So 1 out of 3 homes that are on the market right now are in new construction. And what's been going on for the last couple of years, because interest rates are going up, um, is home builders have been buying down the interest rate for you on your loan so that you would buy their house and they can keep their prices high. Well, with that kind of inventory numbers, that's not going to last. They're not going to keep buying down those numbers because they've been doing it for a long time and it cuts into their margins. But with this many more coming online, unless those homes start to sell, you're looking at peaks that are in the 07, 08 range when the whole market came crashing down and just about took the US economy with it, right? That's a big problem. So that caused me to dig a little deeper again and say, okay, I'm seeing some reports that, oh, the stock market's having a bad week. Is it really the end of the economy? Well, now all of a sudden that the stock market's doing bad, economic news reporters are saying, well, maybe the market, the overall economy is bad. Whereas a lot of us that, deal with things outside the stock market have noticed issues, long before now. Well, Ford announced its earnings yesterday, and they were a big miss. So of course it's plummeting, right? So it's going from sort of in the 1375 range. It was down to 1240 last night in aftermarket trading. Is probably not going to have a great day today. Tesla, say what you want about Elon Musk, he's been building a lot of cars, right? So, but in last week, their sales numbers didn't quite make it either. So they were at 240 something 5 days ago. Currently, they're trading significantly lower than that. They're coming in at like 215, 213, somewhere in there. So the not good news for Tesla or Ford, which is sort of the overall bellwethers for the automobile market. So two car companies not making their numbers, that's not a good sign. Finally, what does all this mean? Well, a lot of times what you see is a lot of the economy is based on interest rates. So the higher the interest rate, the less we're going to spend because we got to pay a lot more interest, and we only have so much money that we make, right? So you can only pay so much money out every month. Otherwise, you wind up with a 2008 situation where you can't pay your bills, and a lot of homes get foreclosed, a lot of cars get repossessed. Remember all those 90 days delinquencies? That's right on that cusp of being foreclosed or repossessed. So the Federal Reserve rate is what drives that interest rate we all pay. Well, for years, it was kept at like 0.25% from that '08 housing crash where they had to cut rates to get the housing market boosted back up. They kept it at 0.25%. Well, here they started raising it because inflation started kicking in. And the way you keep inflation under control is you lower that interest rate. Well, then COVID hit and we lowered it back to 0.25%. And then if you remember, inflation went insane where grocery store prices were through the roof, everything went up, and they raised that interest rate and they finally got inflation under control. Well, now what they're talking about is, hey, look, the overall economy is kind of having issues. Now we need to lower that rate, lower it now, because hey, if you lower that rate, the stock market will go back up. Well, those of us that live in the rest of the economy outside the stock market, you've got this problem where if they lower that rate, yes, my interest rate if I go buy a car or a house comes down, but inflation comes back. So we've got this problem where it's not just, hey, this or that. It's we seem to have an issue at sort of a top level where we're like, hey, let's just worry about the stock market and everything else will be okay. Well, the trouble is 60 something percent, of Americans live paycheck to paycheck. There's a large part of Americans, more than 40%. Last time I looked up the number, and please look it up for yourself, have less than $5,000 in savings. So you can't really go buy a bunch of stock if you got 5 grand, and that's all you got, right? So if you got $5,000 in savings, and I'm not talking, hey, you've got money in a 401k or an IRA. I mean, you've got $5,000 to your name. That's it, right? So you can't really necessarily go spend a bunch of money on stocks because you might need that for a medical emergency. The car might break down, whatever it is. But if you look at all these numbers in a giant pile, that looks at the overall economy and says, maybe there's some ugly stuff going on out there. And with all the changes that have been going on from COVID to everything else that's happened, we've kind of gotten in this weird mix where we say, oh, look, housing prices are always up, so that's fine. The stock market's always up, so that's fine. Those things are starting to come back down. So what does that mean for the overall economy? Well, if you look at housing, it drives sort of 20% of GDP between the sale of the house, the builder, the realtor, the title company, the insurance company, the banks that did the loan. It's sort of 20% of GDP. Well, that's a big thing to have kind of crash out from under us. And that's sort of going to drive the rest of the economy. So that has to stay healthy. But I think in the last couple of years, what we've had is prices that have just gone insane. Rents have gone insane. A house that was 2 years ago was $1 million is now $2 million. Well, that's odd. That doesn't seem really all that possible. So, we need to kind of look at what has gone on and are we out of pocket in the economy and what's it going to take to get it back to where it actually works for everybody, not just sort of this fraction of people over here or this group of people over here. It needs to kind of work for everybody. Otherwise, it doesn't work for anybody, right? So what does all this mean? I think we've got some economic shifts coming, and I don't think they're good. I think they're going to be difficult. And I think they're going to be difficult for everyone. So whoever is the next president or current president, whenever things start to kind of fall apart more, has some very difficult decisions to make. And I think Congress, Senate, President of the Federal Reserve all have to really start to look at the overall economy and what's actually going on out there, not just look at housing or the stock market. You have to look at everything in a big basket. You can't just look at one little bit piece or another. So I hope this helps everybody see why I'm looking at all this stuff, and I'm going to keep digging into these numbers as we go along. But I think there's a people in the news would call it correction. Most of us would call it a crash. I think there's at least a recession coming, and it could be a big one. So take appropriate steps. Hope everybody has a great day.